Good morning and welcome to Market Monday for December 22nd, 2025. We hope everyone had a happy Hanukkah for those who celebrate, and wishing you a very Merry Christmas later this week. As we've talked about ad nauseum, this year's been pretty good in markets. In fact, it's been a pretty good year the last 3 years in the markets, which right on cue has pushed the Bank of America Fund Manager Survey, the cash allocation, meaning how much cash are funds holding as opposed to being invested in the market, and this is now at the lowest point ever. But you see these spikes when cash allocations are at their peaks? Yep, often marking stock market bottoms. .com, global financial crisis, COVID, 2022. So after 3 good years in the stock market, clearly we're not at lows, but does that mean that we have to be at a high? Do we always have to label the market and categorize it as black and white, bull or bear, low or high, bubble or not? We prefer to observe things, how they are, without the need to label it, which leads us to one of our all-time favorite charts. Do you remember the S&P 500 stock market had a 19% pullback this year? Seems like a distant memory, no? Yet, what was happening during that time? Clearly the world was coming to an end with a tariff tantrum. And what do you think analysts were doing? With the S&P 500 stock market at 6,700 at the time of this writing, that's right about here. First of all, kudos to Wells Fargo, Morgan Stanley, and UBS analysts for staying the course. Look at what all these other analysts were doing at that time. No one can predict the future, which is the point. But most of these folks were doing what analysts generally do, which is follow the current market. So when fund managers' sentiment is at its highest since 2021, our ears perk up, and we adopt a not necessarily defensive posture, but certainly cautious. And going back to this theme of not just tolerating a drawdown, but expecting it, and maybe even embracing it, we believe this is investing from a position of strength. Not only do fund managers have the lowest cash on hand in years and the most bullish sentiment in years, but households have more of their net worth in stocks than in real estate. A phenomenon that doesn't happen very often. Maybe a bit of a quirkiness around COVID, but before that only during the .com bubble. If you think we're saying that the market is in a bubble that rivals the .com crash, please rewind the video. We're not labeling the market, but instead acknowledging that it's been a good few years. Sentiment has finally shifted more bullish, and households are highly allocated to stocks. So for next year, at least for a part of the next year, we're cautious and expecting some type of drawdown, with the perspective that stock markets should not be viewed in horizons of 1 year, but several years, many years, and even decades. This is our TED Talk, but folks, we believe this is how we serve you best. And today, we'll leave you with these 3 major developments entering 2026. The DTCC, an organization that is basically the warehouse for securities registrations and tracking that we all use, but don't see it or feel it, that custodies over 100 trillion of assets and has settled over 3.7 quadrillion worth of trades, has just been granted authorization to begin tokenizing assets in their custody. Of course, in a controlled trial environment at first. Next up, Visa begins allowing US banks to settle transactions 7 days a week using USDC stablecoin, or digital dollar, in this case on the Solana blockchain. And finally, JP Morgan, yes, that JP Morgan, and yes, this JP Morgan.
I've always been deeply opposed to crypto, Bitcoin, etc. You pointed out the only true use case for it is criminals, drug traffickers, anti-money laundering, tax avoidance.
Has launched their first tokenized fund, the My On-Chain Net Yield Fund, ticker MONY, on the Ethereum blockchain. Surprised? We've been teeing up this topic all year long. Merry Christmas and have a great week.